Hello, everyone. Thank you for joining today's webinar. Today's topic, tokenization, the future of financial markets, is a really exciting topic and super central to the thesis of fifth era and blockchain co-investors. For those of you who don't know me or haven't met me, my name is Mitch Rashegan. I'm a partner at the firm. I lead our direct investments and I'm based in London. Very excited to talk about this topic because it really is probably the core unlock of blockchain technology, at least as it relates to financial markets. And financial markets is the central piece of our firm's thesis in terms of the value that blockchain technology brings. So I think it's very critical, it's very topical. There are companies now going public in this space and a lot of activity from some of the world's leading financial institutions, from BlackRock to Apollo to KKR. So I think it's a very good time to sort of start from the ground up and say, why is this an important topic and what's going on in the market? So I do have to show you this disclaimer. This webinar is purely for educational purposes only. If you do want to reach out about our funds, please do so through official channels or our email at ir@blockchaincoinvestors.com. So a little bit on the firm first. Blockchain co-investors and Fifth Era, we've been investing in innovative technologies for more than 10 years. We now manage actually 8 funds. We just did our first close on our 8th fund last week. Our fund of funds is how we got started. We've backed more than 50 funds, which makes us indirect investors in more than 1,500 portfolio companies, and more than 80 of those are unicorns. So we're very proud of this. We're now an SEC registered RIA and registered in the UK and Switzerland as well. So the core thesis for our firm in terms of blockchain is that just as the internet digitalized communications and content, blockchain technology is uniquely positioned to allow all of the world's financial infrastructure to be upgraded such that we can digitalize commerce. And in effect, that means be able to achieve natively digital monies, commodities, and assets. So just as the internet age was digitalization of information, we think that blockchain technology allows for the digitalization of financial products, stocks, bonds, dollars, and that ultimately, a very large percentage, if not all economic activity could eventually be transacted, custodied via blockchain networks. So taking it from the top, you may have heard the phrase software is eating the world. That's from Mark Andreessen, shortly after the financial crisis, where he basically put a question to, his readers, what could happen if the cost of compute were to go to zero? What could we do with software? And his basic thesis is that software could ultimately be woven into all parts of the economy. And we really haven't seen that yet with finance, right? I think finance is sort of one of the last bastions where you really didn't see, you obviously saw some software come, but not natively to assets, right? And so I think that's what we're talking about here is how do we get actual digital monies, digital commodities, and digital assets, and ultimately digital financial products rather than sort of a paper-based, analog-based system with very large intermediaries gatekeeping the records. We actually see the emergence of digital finance as at the confluence of 3 innovation trends, and that is fintech, blockchain, and AI. So we invest behind all of these and position our firm to do so. We think again, blockchain is sort of the very bottom layer, right? Sort of custodying, securing, moving these assets and value. Fintech is what you might call the sort of interface layer, right? Making these things easy to use, easy to see, and easy to navigate. And then AI has recently emerged, obviously making these much more iterative and smart and algorithmic. And so we think the confluence of these 3 trends is really what's going to unlock what we call digital finance. And so what is tokenization? Like, why does this sit really at the core of our thesis? Well, let's start with the characteristics of crypto. Cryptocurrencies you may have heard of, Bitcoin, Ethereum, and Solana. Those are the cryptocurrencies you can see on the left there. We're big believers in these cryptocurrencies. And why do people care about them? Well, they are secure networks, right? Very difficult to penetrate or hack. You've seen now Bitcoin in operation for almost 20 years without any sort of downtime, basically. They're distributed, right? So very difficult attack vectors. In the case of Bitcoin, right, you have tens of thousands of different nodes, right? So it's a network that is very difficult to take down. They're bearer instruments, meaning that by virtue of you holding them, you truly hold the asset, right? So very different than, if you open your trading account and you hold a stock in there, that actually doesn't signify ownership, right? You've outsourced that to someone else. So by virtue of me sending you a Bitcoin or an Ethereum or a Solana Sol, you actually are receiving that asset. They're programmable, right? So particularly for Ethereum, Solana, and the other smart contract chains, you sort of have arbitrary abilities to code whatever you want into them, whether that's KYC or sort of other backend systems or data tracing to make them much more efficient. They're trustless, right? You don't need to know the person you're interacting with in the same way you do with cash, right? Instantaneous and recently very scalable and very cheap, which we'll talk about. But really, if we're being honest, this is magic internet money or what you might call native internet money in a much less pejorative way, right? So Bitcoin, Ethereum, and Solana are not really linked to anything in the real world, maybe some energy output or some storage space. They're not actually tied to anything real, quote unquote real. Again, we think that these assets all have very valid use cases and are valuable for those characteristics, but if we're being honest, again, it is sort of native internet money. This is where tokenization can come in and sort of extend those characteristics to financial products that you're familiar with. So tokenization, sort of put most simply, is the process of representing real world assets or really anything you could think of on a blockchain. And again, we'll get into the details here, but this effectively extends those benefits of blockchains and crypto that I just mentioned to non-native cryptocurrencies, right? To things that you already know and are familiar with. And this really can now be applied to assets, monies, and commodities. And so it is really the key technological unlock that allows global finance to become natively digital. And the mechanics vary, but here's sort of a simplified version of how you could do it. We'll get into some specific use cases, but think of it as you can sort of issue a token that is tied to something else, right? And you're sort of going to, have an origination process, a structuring process, put it out in the market, offer it. It can be funds, can be lots of different things we'll get into. And once it's there, right, it can be sort of moved around, secondary trading, servicing and custody, programmatically put into it, et cetera, et cetera. So we'll get into some more actual use cases to see how this works. But I think the important part to know returning here, right, is that the idea is that you take those native internet monies, those cryptocurrencies you see on the left there that are secured by blockchain technology, and we try to see what happens if we replace them with dollars, treasury, stocks, bonds, real estate, art, financial products, right? And have those things have those characteristics now in the middle. And if you do that, what we think happens is you now have a 21st century digital first financial system, right? You have characteristics not of cryptocurrency, but of digital finance. And so for us, this is the sort of holy grail of the investment thesis. This is the way we see financial markets developing. We were very early to this, and as you'll see, we're sort of not alone. This has now become a very popular point of view, I would say, which is obviously very good for us and for our funds and for our clients. So we're very excited about this, but I think, the sort of importance of tokenization is very difficult to overstate with regards to blockchain technology and its applications with regards to finance. So let's talk about some actual use cases. What does this actually mean, right? What's actually happening? Well, I think there's two killer use cases, and the first is stablecoins. And you may have heard about this. The two most famous stablecoins are Circle and Tether. Stablecoins are effectively digital dollars, right? So because Bitcoin and Ethereum are volatile relative to the dollar, stablecoins were invented as a way to create a cryptocurrency that is stable. And what better way to achieve stability by pegging it to the dollar? And we'll get into this later on how the peg is maintained. But the sort of top line is that stablecoins are a very, very large part of the global financial system and payment networks already. They are now legally codified into US law by virtue of the Genius Act passing. And virtually every major payment company and financial institution in the world is developing a stablecoin strategy. So this is definitely not a tomorrow use case. This is a happening right now, and companies should have moved on this 2 years ago type of use case. And sort of underlying this is that the legacy payment system just doesn't work pretty very well. And that is also particularly true with international payments. So I think the largest use cases seen right now with stablecoins are particularly with international flows and for individuals living in emerging economies looking for a store of value, right? So basically, anyone with an internet connection now can send digital dollars instantaneously across borders and also put their savings in a dollar denominated asset in the event that their local currency has a history of devaluation. And how do they maintain the peg, right? Are these things really safe? I would argue, potentially that stable coins as issuers are as safe, if not more safe than the traditional banking system. And, that's quite a aggressive statement, at least on its face. But I think when you see how they work, you can see that the over collateralization, is obviously far greater than the reserve banking system that we have. And obviously, there's been several bank runs, and even in recent memory. And these processes are now again codified into US law via the Genius Act. But basically, what an issuer like Circle does is, if you have $100 that you want to get a USDC coin or a stable coin with, you give that $100 to Circle. They will hand you back 100 cryptocurrencies, again called USDC. Circle then will take your $100 and put it into a trust, right? And use that as collateral. The peg is maintained because at any time one USDC is redeemable from the trust one to one. So because of that, because you can just go to the trust and instantaneously redeem your cryptocurrency for $1 or vice versa, put $1 in and get one USDC, you sort of have a natural way to maintain the peg as long as the collateral pool is liquid and at least 100% collateralized and ideally over collateralized. So again, in the US system now, you have Genius compliant stablecoins, whereby the US government has set out rules with regards to audit procedures, where you can hold the collateral, what types of assets can go into the collateral, et cetera, et cetera. And sort of the Spark Note summary is that the collateral has to be held in US dollar denominated short-term treasury assets for the most part, right? So basically, the collateral pool is either in a strict sense, dollars or what's considered a risk-free asset in U.S. financial markets, which are U.S. treasuries. So very, very simple mechanics. Very important, I think, if you're going out there and looking at stable coins, to look at stable coins that use full collateralization methods, right? It is sort of still a nascent market, and the Genius Act now denominates what can be called a stable coin in U.S. markets. But obviously, if you're going outside the U.S., you need to be very careful because there have been instances where stablecoins have been under collateralized, and that is obviously a very different situation. So why is this a today story and not a tomorrow story? Well, I think really the simple way is that they just work better than traditional financial routes. And you can see here stablecoin transfers up against other various ways to make payments or transfers from credit card to international wire to remittance services. And again, all of us have engaged with this system. I live in London. To wire money to myself in the US is normally about $50 and takes several days, you know, especially if you're over a weekend. Well, today, anyone with a stable coin account, either on, let's say, a Coinbase or on your own self-custody wallet, you can send in less than 1 second money anywhere on earth for 1/100th or even in many cases 1/1000th of a penny. So you can see the direction this is heading, right? Why this is such a breakthrough and why, I'll show you in a few slides, every major payment system is looking at stable coins, it is a much more efficient route for sending money in many instances. And this is no secret, so the stablecoin supply now is in excess of 300 billion. Um, Stable coins, if you actually strip out, and look for real payment volume, right? So sort of the notional volume this year is 46 trillion. A lot of studies have been done to look and say, okay, what's actually being used for real payments, and on an adjusted basis, that's about 9 trillion. That's more than 5 times PayPal's volume. That's about equal with Visa and about 3 times MasterCard's payment volume, right? So you're talking about in a very short amount of time, sort of quietly, again, if you're not paying attention, stablecoins being one of the top 5 routes for payments globally. I mean, it's very amazing how fast it's moved. And it's very exciting again for the industry and as the first breakout case of tokenization. And in recent months, I'd say particularly since the Act passed, that sort of was the starter gun firing for US financial institutions because before the legal framework for stablecoins was unclear. It wasn't exactly clear if they were regulated and there weren't clear rules on what was a compliant stablecoin. But since August, that is behind us. So in August, the law was signed in both chambers of Congress and passed in both chambers of Congress and signed into law by President Trump. So the US law now creates a framework for stablecoins. There is no gray area. And since then, you've just seen tons of activity, from PayPal, which has launched its own stablecoin, to Visa, which is now allowing merchants to make payments in stablecoins, to JP Morgan, which is doing a token coin, which is very similar. In this, just basically, this chart tracks the number of mentions in the SEC. Again, it's sort of not a direct measure, but just give you a sense of the interest, right? It's sort of spiked, right? And I think that this is something that is very, very important to leading payment and financial institutions. This is a little bit of a digression, but I think it's also interesting. I did my thesis at the London School of Economics on cryptocurrencies and state capacity and how states would respond. And so I always find this very interesting. But why do you think the US passed that law so quickly, versus other laws? And why was there very strong bipartisan support? I think a big reason, and it's again sort of been quiet, is that stablecoins quietly now are the 17th largest holder of US treasuries in the world. And at a time where you have traditional buyers of treasuries over the past few decades, your China, Saudi Arabias that have sort of slowly taken down their relative holdings, as the US sort of decouples from areas, that obviously creates interest rate pressure, on the US, right? You need a buyer of treasuries in those auctions. Stable coins have emerged now as a top 20 buyer and growing, right? Putting them ahead of countries like South Korea and Germany and natural allies. So it's very, very interesting development. And I think this is a big reason why that members of both parties can basically see that stablecoins are a route to extend dollar dominance because you digitalize dollars and there's huge demand for dollars globally, and also create a new purchaser of treasuries, which can effectively fund US government operations and keep interest rates lower than they otherwise would have been. So a bit of an aside, but something I find very, very interesting and really outside of crypto circles, not a lot of people are talking about or even aware. So what's the other use case? Well, the next use case is tokenized money markets, right? So again, stable coins are digital dollars, right? So I have a dollar and I'm going to issue a token that represents a dollar. I've tokenized a dollar. I'm trying to create a synthetic dollar. Well, a money market is basically doing that with a treasury. How can I create a synthetic basket of treasuries or digital treasuries? The most notable one is the BlackRock Buildle Fund. Our portfolio company, one of our largest companies, which many of our LPs have invested in. Securitize is the tokenization partner for BlackRock and is going public. So again, this is sort of, very much, happening in the news right now, a very exciting time. But there are, many other top firms from KKR, Hamilton Lane, Apollo, who are, basically, again, all the largest asset managers are leaning in heavily, and we've seen a variety of funds and fund types get tokenized. But I think money markets is definitely the next killer use case. And it works a little differently than stable coins, right? So instead of just holding a basket of dollars effectively in reserve and saying you can come exchange it at any time, which is basically how a stable coin works, it's very simple. What BlackRock did with the Buildle Fund, what you've seen more is the actual native issuance of LP units via blockchain, right? So the Buildle Fund, which is a tokenized money market fund, effectively what they've done is they've said BlackRock manages a fund. This fund buys treasuries. We're going to issue, if you want to buy in this fund, instead of issuing standard fund docs and doing what many of you are familiar with, you're actually just going to buy this token. And by holding this token, that is your ownership in the fund. There is no other ledger, paper-based or run by somebody else that says you own the fund. Basically, there's just a token that says if you hold this token, you get the distributions from it. So very interesting. It's BlackRock's first tokenized fund. It's the most successful tokenized thing out there other than stablecoins. So the most successful tokenized treasury or fund in general. In the first 6 months, the AUM went to 500 million, and now it's in excess of 3 billion. And Securitize is expecting to close its public offering in Q1 or Q2 of next year. So really, really exciting time. We'll come back to Larry Fink, but BlackRock, among others, is very much leaning into tokenization of their existing products as a new avenue for growth in the future of financial markets. So again, just kind of backing up to where we started, you can now start to see the direction of travel, right? Tokenization allows us to bring, we start with internet money, now we have dollars, now we're getting to funds, right? And you can see the way things are heading and sort of next on the list, which, these things just kind of ramp up in difficulty, right? So it's also about, marginal cost, lowest hanging fruit. Next on the list, things like equities, things like bonds. People have been talking about real estate for a long time, very difficult to do. My view is basically the things that are the most fungible are the easiest, the things that require the least diligence. A dollar, nobody needs to diligence. I know what a dollar is, I can just hold the token. Money market fund of treasuries is sort of similar. You know what treasuries are, it's riskless asset, US government. I don't need a diligence. When you get to something like real estate, every house, apartment, commercial building is sort of unique. You're probably not just going to buy the token. So a lot more work needs to be done to set up those markets. But again, very exciting on the tokenized fund by Buildle, and there's been a lot following suit, right? So this isn't even all the way up to date, but now we're nearing $10 billion in tokenized money markets. So, right, these are not small markets, right? I mean, we're starting to chip away, and also we're starting to, it takes a long time for a BlackRock to launch a fund, right, on a blockchain, on a public blockchain, right? These are now funds on Ethereum and funds on Solana. So super, super interesting stuff happening. And again, we've seen, Securitize in particular, they've tokenized Apollo credit funds, right? So, and again, just think about it as the exact same rationale for why you would buy an Apollo credit fund. I want yield. So I'm going to buy the fund, they're going to send dollars to my bank account. Well, now you can buy Apollo credit fund via token, and they're going to send money to your crypto wallet. So again, very interesting. And Securitize in particular has done a great job getting, world-class financial institutions to sign up and to come into the space. So what's next? What is the future of financial markets? And I always like to kind of just put the timeline in perspective because I think blockchain in general, particularly in the 21 to 23 range, right, got a ton of media attention. And sort of this was an expectation of where's the use case, where's the use case, where's the use case? What's taking so long? And I think if you look back at the internet, right, and you say, okay, when was this in technical development and when did it start to commercialize? And you can kind of see that the internet, right, the first iterations in the 60s, we have some emails sent in the 70s. But it's really not until web browsers and Netscape Navigator launched in 1994, I believe, that you really get widespread commercial use. So you sort of have this 30-year period where the internet's developing in the background, but if you ask someone on the street, they haven't heard of it, or maybe they've heard of, some professor sending emails around at various research universities. it's not even until the 2000s, right, the noughties and the 2010s, till you get what you might call internet first businesses, right? Businesses that could not have been built prior to the internet, things like social media, mobile cloud. So it took some time and a lot of iteration and a lot of failure, right? Hundreds and hundreds and thousands of companies started and failed and lots of capital formation and arguably two big spikes from, the late 90s spike and the GFC before you get, the sort of flooding of IPOs of the 2010s from Facebook to Snapchat to, kind of these trillion-dollar tech companies we have now. But it took a lot longer than we think, even though it did feel like it was moving fast. If you look at blockchain, right? I mean, Bitcoin white paper is just 2008. So we're about 16, 17 years in. Smart contract blockchains 2013, stablecoins 2014. So again, I just think if you step back and you say within 15 years, you have Bitcoin as a top 10 asset in the world in terms of value. You have the most successful ETFs ever to launch are the Bitcoin and Ethereum ETFs. You have now multiple publicly traded companies, and you have stable coins, just one use case of blockchain technology being a integral part of the payment system and treasury market. It's sort of slowly is happening faster than we think, right? And so I do think that the Netscape Navigator moment is stable coins. And I think that that is sort of the very first breakthrough thing where stablecoin payments will, the writing is sort of on the wall, right? And I think all of the, from Visa to PayPal to, MoneyGram to, Fiserv, right? I mean, basically anywhere in the payment stack from processors to remittance companies, every single one already is in stable coins or is very public about having a stablecoin strategy. And if you look, I mean, the market continues to grow quite nicely, right? I think, more than 700 million owners of crypto and 180 million active addresses, right? I mean, again, this is sort of financial products, very boring stuff, right? Blockchain technology is sort of again, I always say it's a boring financial back-end technology. There are other use cases, but sort of the core thesis financial use cases is not a very exciting one. And I think the growth and usage has been quite high in the amount of time. And if you look at the top, right, and you say, okay, what are the world's greatest financial players saying about it? I mean, it's pretty stunning. BlackRock has really been in the lead again. I mean, obviously they've launched the Bilbo Fund, but Larry Fink, arguably the most powerful Wall Street executive, BlackRock, largest firm, 10 billion assets. His quote, I believe the next generation for markets, next generation for securities will be the tokenization of securities, right? Instantaneous settlement of bond stocks, no middleman. We're going to bring down fees dramatically, right? So you can, again, I think just the point of this webinar is to see the direction of travel, right? And why this technology is so important is that it really is coming back to it, software coming to finance, right? There's really no reason why, I shouldn't be able to pay for my coffee by, instantaneously liquidating, an Apollo credit fund I have, having that converted into stablecoin and paying for that coffee. With blockchain, that is actually very, possible and trivial once the market is set up, right? So you can really start to think about finance, as much more puzzle piece interoperable. And again, it really all comes back to this slide, which is, what does the financial system look like if its characteristics are those red attributes you see in the middle, right? The attributes that now we sort of assign to Bitcoin, Ethereum, Solana, etc. What if those attributes could be applied to our existing financial products? And again, I think the way I see it is it sort of starts at the top, the easiest thing, and it can crawl its way down and it gets harder and harder and more difficult to build those markets. But really, it's just a matter of time. So that concludes the webinar. Hope you enjoyed it. Again, I think it's a really critical technology. As a fund and firm, we're sort of heavily invested in this space and very excited about it. And again, I do think it is potentially the most critical thing to understand about blockchain, at least as it relates to its financial applications. Probably the other one being DeFi, which we've done webinars as well. But I think, tokenization of existing financial markets is definitely the sort of biggest opportunity we see for the space. And very happy that you all are able to join and learn about it with us. And if you have any questions or want to discuss any of the topics in this or any of our funds or investment strategies, do not hesitate to reach out. You can reach us pretty quickly at ir@fifthera.com. So thank you very much for joining and have a lovely day.